The shadow banking system explained. Hey everyone, welcome back to the channel. Today we're diving into one of the most important yet misunderstood parts of our financial system, shadow banking. Now, I know what you're thinking. Shadow banking sounds like something sinister, like banks operating in dark alleyways or some kind of financial underworld. But the reality is both less dramatic and more fascinating than that. The shadow banking system is a massive part of our economy, handling trillions of dollars, and it touches your life in ways you probably never realized. By the end of this video, you'll understand what shadow banking actually is, why it exists, how it works, and most importantly, why regulators and economists lose sleep over it. We'll also explore how it played a starring role in the 2008 financial crisis and what's changed since then. So let's get started. What is shadow banking? First, let's define what we're talking about. The shadow banking system refers to financial intermediaries that function like traditional banks, but operate outside the regular banking regulatory framework. Think about what a traditional bank does. You deposit money, the bank holds on to some of it as reserves, and then lends out the rest to borrowers. Banks create liquidity and credit in the economy. They're also heavily regulated. They need licenses, they're subject to capital requirements, they have deposit insurance, and they're supervised by central banks and financial regulators. Now, shadow banks do similar things. They provide credit, they create liquidity, and they help money flow through the economy. But here's the key difference. They do this without being subject to the same regulatory oversight as traditional banks. The shadow banking system includes entities like money market funds, hedge funds, investment banks in certain capacities, private equity funds, and various special purpose vehicles. It also includes activities like securitization and repurchase agreements, which we'll explain in detail. The term shadow banking was actually coined by economist Paul McCulley in 2007, right before the financial crisis. He wasn't using shadow to mean illegal or nefarious. Instead, he meant these institutions operate in the shadow of traditional banking regulation. Here's a mind-blowing statistic. According to the Financial Stability Board, the global shadow banking system was worth around $63 trillion as of recent estimates. That's about 40 to 50% of the traditional banking system's size. We're talking about a parallel financial universe that's roughly half the size of regular banking. Why does shadow banking exist? So why does shadow banking exist in the first place? There are actually some good reasons. First, regulatory arbitrage. Traditional banks face strict capital requirements and regulations that can be costly. Shadow banking entities found ways to provide similar services without those constraints. This isn't necessarily about breaking rules, it's about operating in areas where the rules are different or don't exist yet. Second, specialization and innovation. Shadow banks often provide specialized financial services that traditional banks either can't or won't provide. They can take on different types of risks, serve niche markets, or create innovative financial products. Third, efficiency. Without heavy regulatory costs, shadow banks can sometimes operate more efficiently and offer better rates to borrowers or higher returns to investors. Fourth, demand from investors. Large institutional investors like pension funds need places to park massive amounts of cash where it's safe and liquid. Traditional bank deposits are only insured up to certain limits, so money market funds and other shadow banking vehicles fill this need. Finally, shadow banking helps with credit distribution. It provides additional channels for credit to flow through the economy beyond traditional banks. This can be beneficial, especially when traditional banks are constrained or risk-averse. The problem? All these benefits come with significant risks, especially when things go wrong. How shadow banking works. Key mechanisms. Let's break down some of the key mechanisms that make shadow banking work. These might sound technical, but stick with me. Understanding these is crucial. Securitization. First up, securitization. This is the process of pooling together various types of debt, like mortgages, auto loans, or credit card debt, and selling them as securities to investors. Here's how it works. A bank originates a bunch of mortgages. Instead of holding them on its books, it bundles hundreds or thousands of these mortgages together and creates a security backed by those mortgage payments. These are called mortgage-backed securities, or MBS. The bank then sells these securities to investors. Now the bank has cash to make more loans, and investors have a security that pays them returns based on the mortgage payments. Sounds reasonable, right? The problem emerges in the incentive structure. When banks can immediately sell off loans they originate, they have less incentive to carefully vet borrowers. Why worry about whether someone can pay back a 30-year mortgage when you're selling that loan next week? This originate-to-distribute model was one of the key factors in the 2008 crisis. Banks loosened lending standards because they weren't holding the risk. They were passing it on to investors. Repurchase agreements, repo. Next, let's talk about repos, short for repurchase agreements. These are essentially short-term loans secured by collateral, usually treasury bonds or other high-quality securities. Here's the setup. Institution A needs cash overnight. It sells securities to Institution B with an agreement to buy them back the next day at a slightly higher price. That price difference is effectively the interest on the loan. Repos are crucial for financial market liquidity. They allow institutions to quickly raise cash without actually selling their assets. The repo market is enormous. Trillions of dollars flow through it daily. But there's a catch. Repos create interconnected webs of obligations. If one institution fails to honor its repo agreements, it can create a domino effect. Also, during times of stress, the repo market can freeze up. When everyone's scared, no one wants to lend, even overnight. This is exactly what happened in 2008, and again briefly in 2019. Money market funds. Money market funds are investment funds that invest in very short-term, high-quality debt securities. They aim to maintain a stable net asset value of $1 per share. For investors, they function almost like bank accounts. You can put money in, earn a bit of interest, and generally pull your money out whenever you want. Many businesses and institutions use them as places to park cash. The problem? Money market funds aren't actually banks, so they don't have deposit insurance or access to central bank emergency lending. But investors often treat them as if they're just as safe as banks. In 2008, when Lehman Brothers collapsed, one prominent money market fund broke the buck. Its net asset value fell below $1 per share because it held Lehman debt. This triggered a run on money market funds industry-wide, with investors pulling out hundreds of billions of dollars in days. Special purpose vehicles. Finally, special purpose vehicles or SPVs. These are legal entities created by companies for specific limited purposes, often to hold assets off the main company's balance sheet. Banks used SPVs extensively before 2008 to hold securitized assets. This allowed them to move risk off their books and free up capital for more lending. Sounds great, except many of these SPVs were funded by short-term debt that needed constant refinancing. When the crisis hit and markets froze, these SPVs couldn't roll over their debt. The banks that created them had to bring the assets back onto their balance sheets, revealing that the risk had never really gone away. The 2008 financial crisis. Shadow banking's darkest hour. Now let's talk about how shadow banking contributed to the 2008 financial crisis. This is where all these mechanisms came together in the worst possible way. In the years leading up to 2008, shadow banking grew explosively. The originate-to-distribute model encouraged loose lending standards. Banks were giving mortgages to borrowers with poor credit, subprime mortgages, because they could immediately securitize and sell them. These mortgage-backed securities were then sliced into different tranches with different risk levels. The riskier tranches offered higher returns. Some were even further bundled into complex instruments called collateralized debt obligations or CDOs. Credit rating agencies, which were supposed to assess risk, gave many of these securities top ratings. Why? Partly because they were paid by the institutions creating the securities, a clear conflict of interest, and partly because their models failed to account for the possibility of a nationwide housing price decline. Investment banks, hedge funds, and other shadow banking entities were highly leveraged. They had borrowed heavily to buy these securities, magnifying both potential gains and potential losses. When housing prices started falling in 2006 and 2007, mortgage defaults began rising. The securities backed by these mortgages started losing value. Suddenly, everyone realized these supposedly safe investments were actually toxic. Here's where the interconnectedness became deadly. Banks and shadow banks relied on repo markets for daily funding. As the value of mortgage-backed securities plummeted, institutions didn't want to accept them as collateral anymore. The repo market seized up. Money market funds faced redemptions as investors panicked. When the Reserve Primary Fund broke the buck after Lehman's collapse, it triggered a full-scale run on the money market fund industry. Investment banks like Bear Stearns and Lehman Brothers, which relied on short-term funding markets, found themselves unable to roll over their debt. Bear Stearns was acquired in a fire sale. Lehman Brothers collapsed entirely, setting off a global panic. The shadow banking system experienced what was essentially a bank run. But unlike traditional banks, these institutions didn't have access to deposit insurance or Federal Reserve emergency lending facilities. The crisis spread globally within days. Governments had to step in with massive bailouts and interventions. The Federal Reserve created emergency lending facilities for institutions that had never had access before. The result was the worst economic downturn since the Great Depression. What's changed since 2008? After the crisis, regulators asked, how do we prevent this from happening again? The answer involved extending regulation into the shadows. In the United States, the Dodd-Frank Act of 2010 introduced sweeping changes. It created the Financial Stability Oversight Council to monitor systemic risks. It subjected large non-bank financial institutions to Federal Reserve supervision if they were deemed systemically important. Money market funds were reformed to reduce run risk. Some now have floating net asset values instead of the fixed $1 per share. They also have new liquidity requirements and can impose fees or gates to prevent runs. Banks now face stricter capital requirements, especially for risky activities. The Volcker Rule limits proprietary trading by banks. Securitization practices have improved with requirements for skin in the game. Issuers must retain some risk. Internationally, the Basel III framework imposed higher capital requirements on banks and introduced new liquidity standards. The repo market has also seen reforms, though it remains complex and somewhat opaque. But here's the thing. Shadow banking hasn't disappeared. It's evolved. Some activities have moved into areas with less regulation. New forms of non-bank lending have emerged, like peer-to-peer lending platforms and fintech lenders. The Financial Stability Board continues to monitor shadow banking globally and regularly updates estimates of its size. While the most dangerous excesses have been curbed, shadow banking remains a significant part of the financial system. Living with shadow banking. So where does this leave us? Shadow banking isn't inherently evil. It provides real economic benefits. Credit to borrowers who might not get traditional bank loans, investment opportunities, market liquidity, and financial innovation. The challenge is managing the risks. Shadow banking can contribute to financial instability through excessive leverage, maturity transformation, borrowing short-term to lend long-term, and interconnectedness that can turn small problems into systemic crises. The key lesson from 2008 is that activities matter more than labels. If something walks like a bank and quacks like a bank, if it creates credit and liquidity, relies on confidence, and is subject to runs, then it probably needs bank-like regulation, regardless of what it's called. Regulators continue to grapple with this challenge. They must balance preventing another crisis against allowing beneficial financial innovation. It's a difficult line to walk. For you as an individual, understanding shadow banking helps you understand financial news, economic policy debates, and even your own investment decisions. When you invest in a money market fund or a bond fund, you're participating in shadow banking. When companies get loans to expand, some of that credit might come from shadow banks. The shadow banking system is likely here to stay. The question isn't whether it will exist, but how well we can manage its risks while preserving its benefits. Thanks so much for watching. If you found this video helpful, please give it a thumbs up and subscribe for more content on economics and finance. Drop a comment below if you have questions or if there's a financial topic you'd like me to cover next. Until next time, stay curious and financially informed. See you in the next video.